You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody, welcome to Options Playbook Radio, the program here on the old Options Insider Radio Network, where we break down some interesting options plays, offensive and defensive plays, and tell you how you can incorporate them into your own portfolio. If you're saying to yourself, wait a minute, that's not the usual guy on this program, you're correct. I'm Mark Longo here, and I'm joining Brian on this super duper. It's a special episode. If you can't tell by the number in your podcast player, listeners, it is the 100th episode of this here Options Playbook program. So we thought, what better way to celebrate than by having an extravaganza of epic proportions. So it's going to be really fun. But before I do that, let me introduce your regular host, the options guy himself, Mr. Brian Overby, the senior options strategist over there at Trade King. Brian, welcome back to your own program and happy 100th episode. Spectacular, sir.
Well, thank you, Mark. It's been a very fun ride so far, and I do appreciate the great intro, and I love the fact that we're getting some option experts together to talk about some of the plays that we've done on Options Playbook Radio. We've recently started to get into, after we got through all the basics, we talked about the Greeks, the pricing, we got into each and every strategy that is actually inside the Options Playbook and outlined. And then we started looking at some paper trades, some scenarios that some of the plays might apply to. And a lot of these are around earnings. And I decided to go on out and, put out these paper trades to some other option experts and see what they think about them. And I'm very happy to have Andrew with me today from Option Pit. And I proposed episode 95, which was an iron condor that was done on Wednesday, the 20th of January. And this iron condor, I guess I'll set this up for it. And I want to talk a little bit to Andrew about, what happened with the condor and what his thoughts were. And I've asked everybody to be candid about this. Let me know the good, the bad, the ugly as far as the trade is concerned. So here's the scenario. Here's what we went through. We had on Amazon, the stock it closed that Wednesday at 571.77. And if you recall, Wednesday the 20th was a very volatile day in the marketplace. Amazon was actually at one point down over 25 points and then closed only down $2.70. Now, the other scenario that we needed to know with this is that Amazon was going to announce earnings the following week. Now, that's not the expiration that we dealt with. We just saw a lot of pumped up vol in Amazon, and that the implied volatility in this expiration, the expiration that expired before the earnings, was right around 51% because of the general volatility of the marketplace. And here's what we ended up doing. So we ended up doing an iron condor, and it is mentioned that that is on page 126 of the Options Playbook. That's where you'd find the iron condor. And I'm going to go from the high strike down to the low strike. But what we did was we bought the 592.50 strike, sold the 590 strike, and these are call options, and then went out and on the put side sold the 550 strike and bought the 547.50 strike. Okay. Now, it was noted inside the call that the long straddle at that time was trading for $17. Basically, the 572.50 long call, long put, if you purchased them all in one trade, was trading for $17. And we were looking at a range then by, just subtracting that to the downside and to the upside. The expected range of Amazon over that time period was 587, and on the low end, it was 553. Okay. So we're outside of that range, and we were able to do this trade for a net credit of 78 cents, which meant our total risk was $1.72 per iron condor that we put on. All right. So that kind of summarizes where we were at. And part of my thinking was the markets were volatile and Amazon might slow down a little bit before the earnings and kind of get a hold of itself because it was trading a little crazy, and then go into the earnings. And we'll talk a little bit about what happened after that trade, but I'll now toss the ball over to Andrew and hear a little bit of his comments on that trade. Andrew?
Well, thanks for having me on the show, Brian.
Thank you.
Yet another visit to the Options Insider global radio empire.
He keeps expanding, sir.
I know. So there's a couple things on. One is I think overall selling premium expiring before earnings generally is a decent idea. I like looking for because generally you kind of have that quiet time kind of before the earnings come out. So an iron condor, a good way to do that, making sure it expires before. Also, the iron condor like this, you're picking a pretty short duration. So you're going outside one standard deviation. So all of that stuff, I think, is kind of the right way to look at selling option premium. Basically, you want to sell it and you want it to evaporate or the volatility collapse as soon as humanly possible. That's how I look at selling anything. So at least from a setup point of view, those were good. I think kind of the right way to think about it. On the flip side of that is, on the 20th, I believe, I'm just looking back, I'm trying to think, on January 20th or so, let's see, what was that, the 21st, January 20th, so VIX was almost 30. So what I call that for my trading when we teach at Option Pit, that to me that's like zone 4, which is sort of the danger Will Rogers. We don't sell any premium in zone 4. We look at long gamma trades overall. So I know it's going to sound funny to people, but we find ways to try to sort of trick the long gamma. So I really am looking for trades that make me money when the underlying moves. So I would say if I'm in like zone 1, 2, 3, and you get this kind of pricing in Amazon prior to earnings, where it closes, I'd say, yeah, that's a good idea. I'm in zone 4, I sell nothing. That's the easy answer.
Okay, interesting way to approach it. So basically, I was excited from the volatility aspect, from the volatility of the market as a whole. And when you said that you want to be long gamma, in other words, you're looking to buy strategies when the VIX is over 30 that are basically gamma positive, that you're looking for gamma to explode on. What would be that type of trade that you would look at, Andrew? If you were looking, as opposed to doing something like an iron condor, what would you be looking to do?
Right.
What would
so
be
what
one
we do
example?
is, so an example for that is, so generally for me, anything over 23 VIX, so we're moving at 1.5% per day on average, or more. So I would look, the basic stuff is what we call kind of a fly with a kicker, where I, let's say, buy a call or a put if I have a directional bias. And then I hedge with a butterfly that's out of the money to 1 standard deviation. So if you get a move down, right, the delta flips from, let's say if I'm going to buy a call and then I buy a fly. And what I'll do is I will also, sometimes I will trick the duration, meaning if I'm worried about the market, I want the fly to be nearer term. So if I get the downside move that's hard, my fly will kick. It will make me money. I close it and I pay for the fly and the call that I bought, right? Now I have the upside for a credit, and I just let Mr. VIX at 23 go down and up and down and up, and I have a chance for the trade to be a real home run. So that's one type of position. I got a bunch, but that's the idea of, again, depending on the type of instrument, is it the index? Is it an equity? Is it an ETF? What's the term structure look like? So we try to find trades that are going to give us the risk reward profile to sort of fit the high realized vol. And that's the idea.
And the one big thing I see there, Andrew, that you mentioned is, the gamma of a butterfly. A lot of people don't even think about that, but with a few days remaining to expiration, a butterfly can basically explode as expiration approaches if it's within the sweet spot. And so that's basically your hedge. You're looking at something that's long, that's getting killed by time decay and maybe a volatility crunch, quote unquote. But then you also have another trade that goes along with it that is positive, that wants that volatility crunch, and also is positive time decay. So that's a very interesting way to approach it. Did I sum that up fairly well?
Pretty good. And I generally try to aim the direction of the fly where I think the volatility is going. So, if normally with a trade setup like that, I'll buy a put and a call fly. So if the market goes to 0, I want the put to expand infinitely, right? If we do get that rally back, I want the call fly, the vol to compress, and then the value of the call fly explodes. So that's kind of, I set up something like that when the market, and I don't want to just go out by a strangle necessarily, because like you said, there's, that's decaying like a madman. So you got to be careful.
All right. Very interesting approach. Now, what did happen with this iron condor is that it eventually got a little scary. The very next day, and one thing that I was amazed, so some of my thoughts about the iron condor and why I thought it was an interesting paper trade. And, once again, on Options Playbook Radio, we're always just trying to learn. We're not really trying to put these trades out there as recommendations. But the fact that we could get 78 cents, more than, the expected move out of the money for a $2.50 wide iron condor. And that was kind of surprising to me. I expected that premium to be trading for like 30 cents or maybe 25 cents. And I kind of like the concept that I could get that trade off and hopefully get at least half that premium on the next day to expiration. Basically, I didn't necessarily I didn't want to be in the trade all the way to that expiration date. And I guess that talks a little bit to your point on gamma, Andrew, and that if this thing got anywhere close to the money, and I outlined that on that episode 95, I think I got that right. Yep, episode 95. That if that thing got anywhere close to the short strike, we were just going to get out of that trade. And we're going to take our lumps or maybe even make a profit, depending on what happened to vol and what happened to time decay. But what so happened on that trade is the next day, Amazon just basically, the range that I have, just looking at the chart here over at Trade King, was it opened at 573. Now, remember, it was at 571 the day before. And the high, it did make a run. It ran up to 580 588 and the low was 568. So there was quite a range, and it closed at 575, almost where it opened at. So at the end of the day, the trade was up about half of the premium. And kind of your thoughts on that. If that was the case, how would you have approached this trade based off of that information, or what might have happened to you during the day, the very next day, which was the Thursday before that Friday expiration?
Well, again, once you trade 588, that's probably a little touchy for how, depending on the size you did. So I have two ways to approach those trades there. One is I put on a size because I think the way you structured it, the risk reward was really nice. You get 78 cents, you're risking $1.70. So you figure, okay, let's say I sell a 5 lot. So the most I'm risking $750. So then at kind of that size of trade, I just sort of leave it, meaning I think there's edge in the vol, and I'm just going to sell stuff. If you're like selling a 10 or 15 lot, now all of a sudden you got $2,400 in risk. You're like, well, again, depending on your portfolio or whatever, that's big. So you'd probably be buying some calls at some point, meaning if you took in on a 10 lot, that's $780 in premium. The problem with Amazon, it's kind of hard to buy a hedgeable. So normally, let's say if you buy one call and you sell a spread, it sort of hedges the trade. So at that point, I would either saying, okay, I'm going to just lose X dollars. Normally what I'd say is I'm down 25% of the premium. I'm just going to close. I'll just take out the side that's not working. I'll try to work out of the put spread and be done. So those are your choices. In Amazon, when you sell iron condors, as I put on a couple of positions in there, there's no real way to hedge short spreads with long contracts because of the the pricing. You got to spend $8 for a call and you get $500 for your spreads. It would just be, you get close. To me, it's about 25% of the credit, and then I'm out. I'm just closing the spread, just assuming that I thought the vol would come in and Amazon wasn't going to move another $20, but surprise, it does. So out I go.
All right. That was perfect. That's exactly the way that I would have looked at this trade too, is that you're so close and there's so much premium that it's really a win or lose scenario. So in other words, you have your goals and your highlights as to where I'm going to get out, either via where the stock price is at or how much percentage premium you're willing to lose. And yeah, you're right. Buying a long call or buying a long put because it's moving against me is pretty tough to do in this scenario, because a lot of times you'll end up losing more on the long call or on the hedge as opposed to you did just by closing out the trade. And it doesn't give you a ton of opportunity in those scenarios. And that's the downside of doing an iron condor in quote unquote gamma week, that last week to expiration. So I did want to say, Andrew, this was an awesome call. I do really appreciate your candor. I love the way that you looked at the market and some of those ideas as to how to approach when the actual VIX is above 30. Never really thought about some of those things that way, and that you're going to try to hedge long options by using butterflies. And what's also interesting with this is that we're going to talk a little bit later on with one of your colleagues, Mark Sebastian, a little bit about Amazon and a butterfly that actually happened at earnings. So those are some of the trades that we're going to look at. So I really appreciate you coming and helping us kick off this Options Playbook Extravaganza of the 100 episode.
Well, I hope the extravaganza continues. Thanks a lot, Brian.
All right. Thanks a lot, Andrew. All right. So that's it for this episode of Options Playbook Radio. We'll be back same time, same place next week. We're going to talk to another options expert about one of the many episodes of Options Playbook Radio. Thanks for listening, everyone. And please share all this information with your friends, family, via Facebook, Twitter, any way that you can.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.